Assalamu alaikum. Hey guys, this is me. In this video, we will be talking about how do Bitcoin transactions work. Bitcoin was created to function as peer-to-peer electronic cash. Whether you are spending or accepting Bitcoin as payment, it is prudent to understand how a transaction works. Bitcoin transactions are messages like email which are digitally signed using cryptography and sent to the entire Bitcoin work for the verification. Transaction information is public and can be found on the digital ledger known as blockchain. The history of each and every Bitcoin transaction leads back to the point where the Bitcoins were first produced or mined. uh, Bitcoin exists as records of Bitcoin transactions. We define a Bitcoin as a chain of digital signatures. Each owner transfers Bitcoin to the next by digitally signing a hash of previous transaction and the public key of the next owner and adding these to the end of the coin. A payee can verify the signatures to verify the chain of ownership. Bitcoin do not exist per se. There are no physical bitcoins, nor do Bitcoin owners have an account. Instead, there is a blockchain which you can think of as a ledger or a record of all the transactions that have ever taken place between Bitcoin addresses. These transactions records are uploaded by the Bitcoin network participants nodes and shared across each of its nodes as balances increase and decrease. You can use a block explorer if you want to see the history as well as current balance of any given Bitcoin address. Public and private keys. To send Bitcoin, you must have access to the public and private keys associated with the amount of Bitcoin you want to send. When we talk of someone owning Bitcoins, what it actually means is that person has access to a pair key comprised of a public key and address to which some amount Bitcoin was previously sent. The corresponding unique private key, a password which authorizes the Bitcoin previously sent to the above public key address to be sent elsewhere. Public keys, also called Bitcoin addresses, are randomly generated sequences of letters and numbers that function similarly to an email address or a social media site username. As the name implies, they are public, so they are safe sharing with them others. In fact, you must give your Bitcoin address to others when you want them to send you Bitcoin. The private key is another sequence of letters and numbers, also generated randomly. However, private keys like passwords to email or other accounts are to be kept secret. Never share your private key with anyone that you do not 100% trust to not steal from you. You can think of your Bitcoin address as a transparent safe. Others can see what's inside, but only those with the private key can unlock the safe to access transaction inputs and outputs. Although it would be possible to handle coins individually, it would be unwieldy to make a separate transaction for every cent in a transfer. To allow value to be split and combined, transactions contain multiple inputs and outputs. Normally, there will be either a single input from a single or larger previous transaction or multiple inputs combining smaller amounts and at most two outputs, one for the payment and one returning the exchange, if any, back to the sender. Let's break down that section of the Bitcoin white paper by looking at a sample transaction in practice. Mark wants to send 1 BTC to Jessica. To do this, he uses his private key to sign a message with the transaction specific details. This message, which must be broadcast to the network, will contain the following inputs. This contains information about the Bitcoin previously sent to Mark's address. For example, imagine Mark previously received 0.6 BTC from Alice and 0.6 BTC from Bob. Now, in order to send 1 BTC to Jessica, there might be two inputs, one input of 0.6 BTC previously from Alice and one input of 0.6 BTC previously from Bob. Amount. In this case, the amount Mark wants to send in is 1 BTC. Outputs, there are two outputs. The first is 1 BTC to Jessica's address. The second is 0.2 BTC returned as change to Mark. This second output is calculated as total of input 0.6 plus 0.6 equal to 1.2. minus the amount Mark wants to send 1 BTC. This might seem confusing, but it's done this way to improve efficiency. And the good news is that knowing the behind the scenes details of Bitcoin transactions is not required to send or receive Bitcoin. Your Bitcoin wallet takes care of that. Broadcasting and confirmations. In the above example, Mark, via his wallet software, will broadcast his proposed transactions to the Bitcoin network. A special group of participants in the network, known as miners, verify that Mark's keys are able to access the inputs from where he previously received the Bitcoin he claims to control. Miners also gather together a list of other transactions that were broadcast to the network around the same time as Marks and form them into a block. Any miner who has completed the proof of work is permitted to propose a new block that will be added or attached to the chain, and by referencing the last block, that new block is then broadcast to the network. If other network participants agree, it's a valid block transaction. It contains follows all the rules of protocol and it properly references the previous block. They will pass it along. Eventually, another miner will build on top of it by referencing it as the previous block. When proposing the next block, any transactions that were in the previous block will now have been confirmed by the next miner. As blocks are added to the chain, the number of confirmations of Mark's transactions increases. Why do some Bitcoin transaction confirmation take so long? Each block can only contain a certain number of transactions, and the number is determined largely by the space available in each block, or the block size, which is 1 MB. The limited space gives rise to the free market, where miners who collect fees choose to include in the next block only those transactions which have included a high enough fee. Thus, higher fees act as incentive for miners to prioritize your transactions. Note that the block size is an arbitrary limit, but the Bitcoin community has chosen to keep the block size as small as possible in order to make it easier for people to operate Bitcoin nodes. Bitcoin Cash, which is a fork of Bitcoin, has a larger block size and therefore requires lower fees for transactions. How much are Bitcoin transaction fees? Fees for sending Bitcoin could be anywhere from a few cents all the way up to $100. The reason for the big variation is that Bitcoin fees depend on both supply and demand, how congested the network is at a given time, the size of your transaction. Size is affected primarily by input. So if your transaction has many inputs, it will take up more block space and demand a higher fee. For example, if you want to send 10 BTC, there is a good chance your transaction will require more inputs than if you want to send 1 BTC. The 10 BTC transaction might consist of 5 plus 2 plus 1 plus 1 plus 1, so a total of 5 inputs, while the 1 BTC transaction might be just 2 inputs, as in our Mark or Jessica example above. Many wallets, including the Bitcoin.com wallet, allow users to manually set transaction fees. This helps you to avoid overpaying. For example, if you are not in a rush, you can set the fee the lower such that it will be picked up by a miner when the transaction is less congested. You can also ensure your transaction are proceeded immediately by increasing your fee. Alright guys, that's enough for today. We will be seeing you in another video. Till then, stay safe. Allah Hafiz.